In 1942, an 11-year-old boy in Omaha, Nebraska, walked into a brokerage office and bought 3 shares of Citi's Service Preferred at $38 each, $114 total. That kid had been saving since age 6. Today, he's worth over $140 billion. And the most remarkable part isn't the money, it's what he did differently from every other investor on the planet. Welcome to Daily Investor. I'm going to walk you through the complete story of Warren Buffett, not just the highlight reel, but the specific decisions, the mentors, the mistakes, and the principles that turned a Depression-era newspaper boy into the greatest investor alive. Whether you're just starting out or you've been investing for decades, Buffett's journey holds lessons that can fundamentally change how you think about building wealth. Let's start at the very beginning. Warren Edward Buffett was born on August 30, 1930, in Omaha, Nebraska, right in the teeth of the Great Depression. His father, Howard Buffett, was a stockbroker and later a congressman. Young Warren was obsessed with numbers before most kids learned to read. At age 6, he bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and sold individual bottles for a nickel each, a 20% profit margin. At age 11, he bought his first stock, those 3 shares of Citi's Service Preferred at $38 a share. The stock dropped to $27. He held on, sold at $40, and watched it rally to $202. It was a lesson he never forgot: patience pays, and selling too early can cost you a fortune. By age 13, he was delivering newspapers for the Washington Post, earning $175 a month, more than most of his teachers. By the time he filed his first tax return at age 14, he deducted his bicycle as a business expense. This was not a normal teenager. At 19, he read a book that changed everything, The Intelligent Investor by Benjamin Graham. Buffett has called it the best book about investing ever written. He enrolled at Columbia Business School specifically to study under Graham. And Graham taught him the single most important idea in all of investing: the margin of safety. After working at Graham's firm in New York, Buffett returned to Omaha in 1956 and started the Buffett Partnership with $105,100, $100 of his own money and the rest from 7 family members and friends. Over the next 13 years, the partnership earned a cumulative return of 2,794% before fees, compared to 152% for the Dow Jones Industrial Average over the same period. Not a single year of losses. Think about that, he beat the market every single year for 13 years straight. In 1962, he started buying shares of a struggling New England textile company called Berkshire Hathaway at around $7.50 per share. He originally bought it as a classic Ben Graham cigar but played a cheap stock with one last puff of value. But this is where Buffett's evolution began. He realized the textile business was a dead end, so instead of milking it dry, he used Berkshire as a holding company, a vehicle to buy better businesses. He dissolved the partnership in 1969, distributing cash and Berkshire shares to his partners. Many of them kept the shares. Those who held on to their Berkshire stock have seen each share go from around $19 to over $700,000 today. This is where Buffett went from very wealthy to legendary. He stopped looking for cheap, mediocre businesses and started buying wonderful businesses at fair prices, a shift he credits to his partner Charlie Munger. In 1972, Berkshire acquired See's Candies for $25 million. At the time, See's earned about $5 million pre-tax on $8 million of net tangible assets. Some thought he overpaid. But Buffett recognized something most investors missed: pricing power. See's could raise prices every year and customers would keep coming back. Over the next 5 decades, See's generated over $2 billion in cumulative pre-tax earnings on almost zero additional capital investment. Then came the big one. In 1988, Buffett began buying Coca-Cola stock, eventually investing about $1.3 billion. At the time, people said he was crazy. Coke was a mature company, not a growth stock. But Buffett saw the brand moat, the global distribution, and the predictable cash flows. Today, that position is worth over $25 billion, and Berkshire collects roughly $776 million per year in dividends alone, more than half the original investment back every single year, just in dividends. In the late 1990s, while everyone was pouring money into dot-com stocks, Buffett refused to invest in technology companies he didn't understand. He was mocked on magazine covers. They said he'd lost his touch. Then the bubble burst in 2000, wiping out trillions. Buffett's discipline saved his investors from catastrophe. The 2008 financial crisis was Buffett's masterclass. While the world panicked, he invested $5 billion in Goldman Sachs on favorable terms, preferred shares paying 10% annually, plus warrants. He invested $3 billion in General Electric on similar terms. He wrote an op-ed in the New York Times on October 16, 2008, titled "Buy American. I Am." In 2016, Buffett began buying Apple stock, a company he'd avoided for decades. By 2023, Apple represented roughly 50% of Berkshire's public equity portfolio at over $170 billion. He called it probably the best business I know in the world. Even in his 90s, Buffett was still learning, still adapting, and still making concentrated bets when conviction was high. As of 2025, Berkshire Hathaway's market capitalization exceeded $1 trillion, making it one of the most valuable companies in the world. Buffett's personal net worth, even after giving away over $55 billion to charity through the Gates Foundation and family foundations, remains above $140 billion. And here's the staggering fact that most people miss: over 99% of Buffett's wealth was earned after his 50th birthday. And over 96% was earned after his 65th birthday. That isn't genius stock picking, that's compounding. That's time in the market. The lesson of Warren Buffett's life isn't that you need to be a financial genius. It's this: find great businesses, buy them at reasonable prices, and hold them long enough for compounding to do the heavy lifting. Buffett started with $114 at age 11. He didn't inherit a fortune. He didn't get lucky on one trade. He simply made rational decisions, year after year, decade after decade, and let time multiply his discipline into wealth that almost no one on earth has ever matched. As he once put it, the stock market is a device for transferring money from the impatient to the patient. Be patient. If Warren Buffett's story teaches us one thing, it's that the greatest investment you can make is in your own financial education. The man reads 500 pages a day and has done so for over 70 years. That's his real edge, not genius, not luck, but relentless learning and patience. If you found value in today's video, hit that subscribe button and turn on notifications so you never miss a daily investor episode. Drop a comment below. What's the most important lesson you've learned from Warren Buffett? I read every single comment. And remember, the best time to start investing was yesterday. The second best time is today. I'll see you in the next one.